Hello. In the previous session of financial statement analysis, we discussed about the different types of financial statements like balance sheet, income statement, cash flow statement and their content. We also discussed about where to get this financial statement information like annual report, websites, etc., analyst reports, and we also talked about how to analyze the financial figures provided by these financial statements. We started discussing about it. In that we discussed about comparative statement, trend analysis and common size statement. In this session of financial statement analysis, we are going to discuss about analyzing financial statements with the help of financial ratios. When you say financial ratios, we mean that there are as usual the ratio means the relation between numerator and denominator. So, we have certain figures in numerator and certain figures denominator, and find comparing those two figures we find a ratio, and these ratios can be found out for different companies. The ratios can be found out for one company for different years, and these ratios also on their own do not mean anything, but when you compare this ratio with another company, relatively you can say which company is better than the other one, or if you are comparing this ratio of one company with of 1 year with another year, then we compare, we find out whether this particular company has done better than the previous year or the last year, or it has done worse than that. So, ratio on its own may not convey much, but ratio when it is compared with the previous figure or another company's comparable company figure, then it makes a lot of sense. So, coming to the next, what are the different types of financial ratios? We have one, the first category ratio is profitability. Profitability ratio means the profit relation to certain things of the company, and there are basically two types of profitability ratios. One is profit relation to the activity of the business like revenue or income of the business, how much profit has happened compared to the income that has been generated by the company during a particular period. Similarly, another profitability ratio that we have is their profit in relation to the investors' money. If the investors have given X rupees throughout in a particular period or on a particular period, how much profit this company has earned on this particular investment. So, that investor can find out whether they have earned enough what they have expected or not. So, the two types of ratios, profitability ratios, one is the relation to the income of the company, another relation to the investors' money of the company. Then we have the next one is efficiency ratio. Efficiency ratio indicates how efficiently the assets or the resources of the company have been used. So, better efficiency reflects the better ratio, will say better efficiency. So, we can say that yes, this company has used assets in a better way or not. So, that is called an efficiency ratio. Then we have the liquidity ratio. Liquidity ratio talks about how liquid is the company in a short run and how solvent is the company, whether this company will be able to meet the obligations during a particular period of time or not, how comfortable the company is in meeting the current obligations. So, this liquidity is also known as short term solvency ratio. Then we have the solvency ratio. Since you have already covered the short term solvency in terms of liquidity, this solvency ratio talks about the long term solvency. Over a long term, how comfortable the company in repaying the loan and how much debt the company has taken in relation to the equity of the company, because high debt could be high risk for the company also. So, those things are measured in terms of solvency ratio. Then we have some other ratio where we talk about the capital market standing of the company. So, in this case, unlike the previous four types of ratio where we get the figures from the financial statement like balance sheet or income statement or something else that is published by the company, in this ratio this type of measurement, that is capital market standing, we talk about certain figures from the financial statement of the company, also certain figures from the market of like capital market for that matter. So, for instance, there is a popular ratio called price to earnings per share, P ratio as such. In that case, earnings per share figure is found out with the help of information from the annual report or financial statement, whereas the market price per share is found out from the market as such. So, that is capital market standing. Then we go one by one different types of ratio here and discuss what is the implication. In the profitability ratio that we have, the first one is the profit margin. So, profit margin means how much profit this company has made in relation to sales of the company or the income of the company as such, and the profit are of different types as such, different type in the different stages of profit. The first level of profit of the company could be the gross profit of the company as such. So, gross profit means actually whatever the sales have taken place and how much cost of goods sold is there in relation to sales, that difference actually gives us the gross profit. So, gross profit can be measured in different ways, and the gross profit to sales ratio, it is always given in terms of percentage, and that shows yes, this much profit has been generated out of the sales, which will take care of rest of the expenses. Anything that is not covered in cost of goods, so now will be covered out of gross profit. Then we have something called operating profit to sales. Gross profit might not have included certain expenses, but they are essential to the business. So, typically what happens in the gross profit, when you say it is sales minus cost of goods sold, this cost of goods sold COGS does not include something called selling expenses. So, in that case the operating profit will take care of this gross profit less any other expense excluding interest. So, that is operating profit, that means having got the gross profit, how much this company has earned, so that it can meet other expenses including selling and distribution expenses, then we deduct that, we got the operating profit, and how much operating profit is there in relation to sales, that is given as a operating profit margin. And this operating profit margin, once you have higher, that means the company has been able to do the business at a lower cost of operation. If the operating margin has increased, that implies that the operating cost of the company has actually declined in relation to sales over a period of time. Then we have the next figure, that is called next ratio, that is called net profit to sales or net profit, it is also known as net profit margin. So, net profit margin nothing but the profit after tax. So, after taking care of all the expenses, operating expenses, any other non operating expenses and interest expense, financial expense and tax, whatever profit is left over, that is known as net profit, and the net profit to sales is popularly known as the net profit margin. At the end of the day, all these ratios, that is profit margin, should always be higher, higher is always better, and that shows the company is able to comfortably meet the expenses and still create some surplus for the investors. Then we have the return on assets, return on investment, which is related to investment. In this we talk about what is the profit that has been earned on the total investment of the company. So, total investment is always reflected as total assets of the company, and the numerator for this ratio is profit before interest and tax or earnings before interest and tax. So, earnings before interest and tax up to total assets gives us the profit return on investment, and this particular ratio should always be in any case higher, so that the company can satisfy the investors. Yes, the investor can feel happy about it, that is the company has earned a lot of return on the investment or adequate return on the investment that they have made in the company. So, if we go back to our example, we have got the profit before interest and tax for this particular company 68.46, which was actually 64.27, it was earlier 46.39, and this profit before interest and tax, which also can be known as something some other way we can also say operating profit. So, this total assets of the company of this company is 494.69, which is in 2008-9, and PBIT is 68.46. So, this ratio between these two is 13.84%, which was actually 13.66% in 2006-7, and 2007 it has gone up to 15.93, whereas it has declined to 13.84% in the latest year. So, one has to now find out why this particular decline has taken place from 15.93% to 13.84%, because it could be because of different reason. That means, the profit might not have increased substantially compared to how this sales of the total assets of this company has gone up from 403 to 494.69 is a lot of increase, whereas the profit before interest and tax has gone up marginally. So, because of that one can see there is a fall in the ratio, that is profit before return on investment from 15.93% to 13.84%. Another way of measuring this particular ratio is to find out the net profit to total assets. In that case, we talk about the net profit of the company, and the divided by total assets of the company total assets and net profit is always there, then that ratio in this company has gone down from 8.97% in 2006-7 to 8.64% in 2008-9. This also could be because of the company has made less profit, or company has made more profit, but the profit growth is not adequate to compensate for the growth in the total asset that has happened during this 2-year period of time. So, this is one. Another way that is discussed as per the net worth total assets, instead of taking the total assets of the latest year, that is closing total assets, one can also look at the total average total assets. And when you say average total assets is nothing but total assets what is there in the opening in the beginning of the year, opening total assets, which is nothing but the closing of previous year. So, closing total assets whatever is there divided by 2, that gives us the average total assets, and instead of measuring the profit to ratio on closing total assets, we do measure an average of these two, that is average total assets. What is the superiority of this particular measure? Instead of taking closing assets, why should we take average total assets? That the company might have acquired the assets in the at the towards the end of the particular period. In that case, it is not right that we expect the profits should be on those total assets which has those assets which have been acquired in the latest time of the period as such. So, to take care of that particular problem, instead of taking closing total assets, there is better that we take the average total assets of, that is average of opening and closing, and this way this company have a return on total assets or return on investment of, in the when return is defined as per net profit, which was 10.78%, it has gone down to 9.52%. One can see here when the net profit as a total asset is measured in terms of closing asset, it is 8.64%, whereas if it is measured in terms of average total asset, it has gone up to 9.52%, possibly because that profit to total assets was more in the previous relation total assets as such. So, this is one of the important ratio that all the investors look at, and next we go to the next type of ratio, that is your DuPont financial analysis. What happens in this case? We have got a combination of profit margin and asset efficiency, and in this what happens, we have the DuPont chart is a very simpler format, but very useful formula, useful analysis method, where we talk about the profit to total assets, that is net profit to average total assets is the return on investment, and which is nothing but, if you expand further, it is nothing but net profit to sales into sales by average total assets. So, what is the beauty of this particular analysis is that one is talking about here net profit margin, another talking about here the sales by average total of assets, which is essentially talk about the efficiency of utilization of asset, and this talks about the how profitable the operations are there. That means, the profitability multiplied with the efficiency talks about the how much return has been on as far as the investment is concerned. So, the investment return cannot be on its own, rather it will be based on the how profitably the operations have taken place, at the same time how efficiently this particular assets have been utilized to generate something called the revenue of the company. So, more this particular ratio, even if this particular ratio remains constant, if this ratio is higher, then also this particular ROI can be higher. Similarly, if this ratio may remain constant, whereas the profitability of this activity could be higher, that also can lead to higher return on investment, and if both the things are taken care, it is higher over a period of time, then there is a double benefit of on the return on investment. So, instead of saying return on investment as a function of profit to total assets, is actually a function of how profitably the company has made the revenue, and also how efficiently the assets have been utilized, that is used by DuPont analysis. In fact, this particular analysis was used for the first time by the DuPont, that is the chemical company, and in that after that this particular analysis has been named by the DuPont itself. Is a very popular analysis. One can start the financial analysis in fact with this particular ratio as such. Then we move on to the next type of ratio, that is your return on equity. When you talk return on equity here, instead of talking about the investors as total, we talk about only the all the equity holders of the company. So, investors can comprise of all the people, that is equity holders as well as debt holders, but here you talk about the equity holders only, and that is we find out the return on equity as a percentage of profit after tax to net worth of the company. So, that talks about how much return that has been earned by the on the equity holders money. So, if you go back to our Excel sheet, we will find out that return on equity of this particular company, which was 16.91%, which is based on profit after tax, that is the reported profit of 30.46 on equity of the company, that is nothing but total shareholders money, which total shareholders funds is given as 180.14 in the 2006-7, and similarly is 257.9 crore is in 2008-9, and this is the denominator, whereas reported profit of the company is 42.74. So, this 42.74 divided by 257.9. So, 42.74 divided by 257.9 into 100 has got return on equity of this particular company for this particular year, that is 2008-9, which is nothing but 16.57%. So, 16.57% return on equity, which is actually 18.27% in 2007-8, which has gone down to 2008 in 2008-9 it has gone down to 16.57%, which is obviously not a good sign that return on equity of this particular company has actually declined, but it could be because of that company might have gone more equity, or it could be because of the profit itself has not gone up substantially in relation to what the equity has actually moved up. This ratio also can be found out with the help of average equity. When you say average equity, you talk about the opening equity plus closing equity divided by 2. As we discussed in average total assets, this is average of the equity of beginning and ending, or average of ending equity of last year and ending equity of this year. In that way, this ratio is actually 17.92%, which was actually 20.06% in the previous year. There in this ratio also there is a decline, which is not a good sign for any company, as that company return on equity has declined. If this return on equity declines over a period of time continuously, there is a warning signal as such, and possibly the investors will withdraw investing from this particular company. They may sell the shares in the market, and the share price of the company can slowly come down. So, the company has to be very careful that under what any circumstance the return on investment, return on equity, all those things should not actually come down. Then we have the next ratio, that is your earnings per share. Earnings per share is the how much profit has been earned on a per share basis. If the company has got, let us say 10 crore shares, and the company has made a profit of 30 crore. So, 30 by 20, 30 crore rupees by 10 crore number of shares, that gives you rupees 3 per share. So, per share rupees 3 has been earned in a particular company. So, higher this particular earnings per share is always better, and any company which is increasing return on equity is quite likely that earnings per share of this particular company might have gone up. So, if you look at our example of Natco Pharma, we have got a number of shares in this case as 2.804 crore, and the earnings per share, which is nothing but the profit after tax, that is 42.74 in case of the latest year, that is 42.74, and divided by number of shares is 2.804. So, earnings per share of this particular company is 15.24 in the latest year, which has actually gone up from 11.02 in the 2006-7, that has gone up to 14.28, and now it has moved up to 15.24. In the earnings per share performance, the company has actually done well. And then we have the next ratio, that is the dividend per share. that is nothing but the dividends declared by a particular company during a particular year divided by again number of shares. In for some investors like senior citizens who earn their bread and butter from this investment in the market, because they put money in the market or they put money when the company comes with the first initial public offering. So, they buy the shares with the expectation that they are going to get some regular return in terms of dividend for the company. So, for such type of people, the dividend per share makes a lot of sense. So, they will always go for those companies which pays a high dividend per share. There will be certain companies will find they pay very high dividend per share, there will be some company which may pay very less dividend per share, but the company may believe that instead of declaring dividend, the dividend can be plowed, this profit can be plowed back into the business, and that they can earn a high rate of return on equity, and that should reflect with that should reflect in a higher market price of the particular share of the company. So, in any case, so dividend per share is found out with the help of this ratio, the dividend declared by divided by number of shares, and in the our case we have got this dividend per share of almost same, which is 1.23 rupees per share, which has gone down 1.2 and has become now 1.25 or 1 rupee 25 paisa per share has been declared as dividend to the shareholders of the particular company. So, this is one more ratio which is actually relevant for those people who will like to earn a bread and butter from this investment as such, and they look at the dividend as a regular source of income to meet their regular expenses as such. Then we move on to the next category of ratio, that is the efficiency ratio of the company. So, when you say efficiency ratio of the company, we talk about the efficiency in asset utilization, we talk about efficiency in terms of the relationship between the sales and the assets, and in this we have different classification, that is we have the efficiency, that is total assets turnover, fixed assets turnover, current assets turnover, and these ratios are actually known as turnover ratios, otherwise known as turnover ratios. Efficiency ratios are otherwise known as turnover ratio, and the turnover means how many cycles have actually been made with the utilizing this particular asset. So, if the turnover ratio is 2, that means the 2 cycle has been made utilizing this particular asset. So, if the total assets is 10 crore and the revenue of the company is let us say 20 crore. So, total as turnover ratio becomes 20 by 10, that is 2 times the turnover has done. So, higher this particular ratio is always better. So, any efficiency ratio should always be higher. So, total asset turnover ratio if it is going up, that means the overall the total assets have been utilized very high. So, we have total assets, we have fixed assets current turnover ratio, then you have current asset turnover ratio, then inventory turnover ratio. So, as far as the these ratios are concerned, we talk about the asset utilization efficiency. Then we have the next ratio is called the current inventory turnover ratio. In inventory turnover ratio, what happens? We find out the inventory turnover ratio is known as ITR by having this cost of goods sold divided by average inventory, and when you say average inventory, we mean that average of opening stock and closing stock. If for any reason closing stock opening stock figures are not there, then closing stock can be taken as the average inventory. So, this talks about how efficiently this inventory has been utilized to generate sales in terms of cost of goods sold. So, whatever that value comes x or y, whatever that may be, we will always expect this particular value to be going up over a period of time. So, higher the ratio is actually better, and from this inventory turnover ratio one can also find out something called inventory conversion period, which is nothing but the 365, that is the average that is the number of working days in a number of days in a year divided by inventory turnover ratio. So, if ITR of any company is let us say 6, and then in that case the inventory turnover ratio if it is 6, then the inventory conversion period will be 365 by 6, which is around 61 days. That means, what is the implication of this is that if this if the inventory is acquired on certain day, it takes 61 days for the company to convert into sales. So, in this case you can interpret, if this particular value is the 61 days is less, then it is always better. Instead of 61, if the 61 days has become, let us say in subsequent days 50, that means on an average the inventory is held only for 50 days to convert, which was actually 61. So, the company should always like to reduce this inventory conversion period from for as many days to as less as possible. And this particular thing 61 days which we are talking about, if this particular 61 days can come down, it can come down over a period of time if this inventory turnover ratio actually goes up. So, in that case, if the inventory turnover ratio has to go up, then the average inventory has to actually come down. So, inventory held during a particular period has to come down, then this ITR goes up. At the moment ITR goes up, then the inventory conversion period actually falls, which should be a good sign up for any company. And companies which go for something like just in time approach inventory, in that case the inventory is likely to be 0 or almost 0, and the inventory becomes almost 0, then ITR becomes very high, and the ITR becomes very high, then inventory conversion period also become as less as possible. In those cases actually just in time concept, the inventory turnover ratio may not mean anything, because in any case the company has no intention of holding an inventory to convert it into sales. Then we have the next ratio called receivables turnover ratio. Receivables arise, as per the company is concerned, receivables arise because of credit sales of the company. So, it is quite natural that the companies make sales on credit basis, and it is also possible that the company may give a period of let 30 days credit period, and companies may end up getting back the money after 30 days or within 30 days or less than 30 days, or maybe possibly after 30 days for that matter. So, for to know how much money is due and what is the liquidity condition of the particular company, when are you going to get back the money, as such we got to something like receivables turnover ratio. Receivable turnover ratio we define by credit sales divided by average debtors. So, this is our receivable turnover ratio, or otherwise known as debtors DTR, that is known as debtors turnover ratio. So, we are now to take look at here, it is taken as credit sales, and if for any reason if the credit sales figure are not available, we presume that all the sales are happening on credit. So, all the sales can be taken as credit sales as such. So, credit sales divide average debtors, average debtor as we have discussed earlier, any average figure is nothing but average of opening and closing figure. So, this ratio should always be, again if this is y, in that case this ratio should be always as high as possible. So, higher the ratio means, that means you are having less money due from the customers who have taken the goods or who have purchased the goods on credit. From this average debtors turnover ratio, one can also go to find out something called average collection period. Average collection period is nothing but how many days on an average it takes for the company to get back the money from the debtors or from the receivables, how many days it takes to realize the receivables into cash. So, if the average debtor turnover ratio for example is let us say 5, and in that case average collection period will be number of days in a particular year divided by 5. So, that comes to 63 days. That means, if 5 is the receivable turnover ratio, for this company it has taken 63 days to collect the money from their receivables. Now, these 63 days can be compared with such figures of different companies of in this particular sector. So, you can see here whether this company is taking more days to collect the receivables, or this company is taking less days to collect receivables compared to the companies in other companies in this particular sector. So, lower this particular value is always good, and this can be lower only if the debtor turnover ratio is higher, and the debtor turnover ratio can be higher only if the average debtors is actually lower. So, this can be achieved with the help of giving some incentive to the debtors that you please pay within time, or if you pay within these many days we will give certain discounts to you. So, in that case it can be achieved, so that the money kept with the debtors is as for as many days is less as far as that is concerned, and then obviously, if the number of days is reduced, 63 days has gone down to let us say 61, 60 like that, it is also obviously a good sign for the company, because the money left with them is for a shorter period of time. Because what happens, whatever money is due, if that money comes to the company, that means they are actually converting the receivables, which is also obviously known as a liquid assets, but it is converted to cash is more liquid assets. So, higher the data turnover ratio, that means lower the average collection period, talks about a better liquidity management of this particular company. And we will always like that the company are managed as per liquidity front is concerned, and for liquidity front they should manage very well. So, that money should not be kept idle, or money should not be with the debtors, rather it should be with the company. So, company has to get back the money as quickly as possible. Next category ratio that we move on is the liquidity in terms of different other measure like liquidity or short term solvency. In this we have a very popular ratio known as current ratio. The current ratio is nothing but the ratio of current assets to current liabilities. As we have discussed in the previous session of finance statement analysis, current assets are those assets which can be converted into cash within a short period of time, and current liabilities are those liabilities which has to be honored within a very short period of time, or typically 1 year. So, in the current ratio one has to find the ratio between current assets and current liability. So, in this case the current asset in the numerator and current liability is denominator. If the current assets of the particular company is let us say 30, a current liability of the company is let us say 15 crores, so current ratio becomes 2:1. This ratio is always measured in terms of something is to 1. That means, for in this, if the current ratio is 2, in that case we say for every 1 rupee of current liability, the company has got 2 rupees of current assets. So, in that case the company can meet all the current liabilities out of the current assets, still 1 rupee of 2:1 the current ratio, having met 1 rupee as the current liability, the company can now have 1 rupee to take care of the expenses that is going to happen over a period of time. So, higher this particular current ratio is obviously better for the company is liquid, but very high current ratio indicates that there is a piling up of the current assets. Actually, current assets on their own does not yield anything. The current assets have to be cycled over a period of time. The current assets like inventory should be converted into sales, that is the receivables, and the receivables has to be collected back in terms of cash, and cash has to be there, so that we can again purchase the inventory. So, that has to be there. If any part of this particular current asset in the current asset cycle, it is piling up, that shows that the money is idle, and money is always financed by certain financiers, where we are paying some interest or they are expecting some rate of return. In that case, actually we will be losing money, because the investment is piling up, which is also not, that means excess current ratio is obviously not good. So, what is excess or low or something like that, one can compare this current ratio of this particular company with the average current ratio of the companies in this particular sector. So, next ratio that we have is the quick ratio, and as per the quick ratio is concerned, see, in the current assets there could be some current assets which cannot be converted into cash as quickly as possible. Current assets typically consist of inventory, that is the goods meant for sale or goods meant for conversion. Then we have another current asset called receivables. Then you have got cash and cash equivalents. So, if these are, and there could be some other current assets. So, if you look at this inventory, receivables and cash equivalent, obviously this particular current asset called cash and cash equivalent is already liquid, and whenever somebody needs the money, it can be paid out of this. The receivables are little more liquid compared to inventory, and inventory is the least liquid among the current assets. So, the company having one company, if the company, let us say we have company A as well as company B, which has got total current assets of 200, whereas this company has 100 rupee in terms of inventory, 50 in terms of receivables, 40 in terms of cash, and 10 in terms of other current assets, whereas this company has got 70 in terms of inventory, 60 in terms of receivables, then for 50 in terms of cash and 20 in terms of other current assets. So, if you look at this, though both the companies has got 200 and 200, as current assets, and presuming that this current liability this company, both the companies are 100 as well as 100. So, the current ratio is obviously 200 is to 100 is 2 is to 1 for company A as well as 2 is to 1 for company B. But if you look at compare these two companies, we have here in this company 100 rupees in terms of inventory, which is not going to be easily converted into cash like any other current asset. Here it is 70, also the same that it can be converted easily, but in this case inventory amount is quite higher compared to company B, and other assets non inventory current assets is higher in this case, non inventory current assets is lower in this case. So, since the inventory is not that liquid, so what happens in this case, we go for something called quick ratio. In quick ratio we talk about the quick assets to current liabilities, and the quick assets is defined as current assets except the inventories. So, in this case in our example we have got the quick assets, that is Q A for company A and company B. If you look at, that is 200 minus 100, that is 100 for company A, and 200 minus 70, that is 130, and the current liability for both the companies are 100. In that case, the quick ratio appears to be 1 is to 1 and 1.3 is to 1. So, quick ratio is supposed to be a more stringent measure of liquidity unlike the current ratio, and if you look at the current ratio in this case we have both the companies are same, that is 2 is to 1 2 is to 1 current ratio, whereas in quick ratio we have got 1.3 is to 1 as the current ratio for company B compared to 1 is to 1 for the company A. So, company B is actually overall liquidity management better than company A because it has got a better quick ratio. So, that is the implication of having a quick ratio as such. Then in the liquidity of short term solvency also we do talk about inventory conversion period and average collection period, as we have discussed in the previous slide. We talk about efficiency ratio, we talked about inventory conversion period and average collection period. So, inventory conversion period talks about how well how quickly this particular inventory purchased or procured is converted into cash. That is inventory gets into sales, then sales that means credit sales, then credit sales means receivables, the receivable gets converted into cash. So, how much time it takes actually for converting the inventory, that is from inventory to sales level, is known as the inventory collection conversion period. From the sales credit sales to collection of the cash, it is called average collection period. So, these two components are major components of something known as working capital cycle. Working capital cycle is something you one purchases inventory, then it comes back in terms of cash by realization from the receivables. That full cycle is known as working capital cycle, and out of that inventory conversion period and average collection period are actually major components. So, these two ratios as I have discussed earlier, these two ratios also should ideally be as low as possible. So, that is the known as these are the things that we talked about liquidity or short term solvency. Now, we talk about something called long term solvency. In the long term solvency you talk about over a long period of time how comfortable is the company in repaying the debt or debt obligations for that matter. So, the first ratio that we have in this case is debt to equity ratio. So, debt to equity ratio talks about something like leverage of the company. That means, a company having all the finances from equity is known as unlevered company or zero leveraged company, and why it is called leverage is that by having the debt in the capital structure of the company, the earnings for the equity holders can be maximized. So, that actually that is why with the same profit level, but the one company with in debt as a component to capital structure can earn a better return on equity than a company having no debt or less debt in the capital structure. That is why that means leveraging the position with the help of debt, that is why there are known as leverage ratio. So, use of leverage will lead to if the company has no debt also, that means we do not talk about anything like long term solvency, debt to equity ratio or any other ratio for that matter. So, debt to equity, in this case equity is defined as the net worth of the particular company. Instead of saying only the paid up capital, we talk about paid up capital plus any reserves and surplus that the company has got. So, debt to equity ratio is measured by debt to equity as such. Then we have the next one is called liability to equity ratio. In this case, we do not distinguish between long term debt or short term, all the liabilities except the equity is captured in the numerator and accordingly it is found out, and there is no rule that debt equity ratio should be high because it gives the leverage. Rather, high debt equity ratio can lead to high risk in the company. We have discussed the risk and return, that we talked about the financial leverage risk as such. The company which has got more debt to equity ratio is actually little more riskier than company which has got the less debt equity ratio. At the same time, zero debt equity ratio is also not advisable. The company has ability to raise the debt, can as well go for, so that because of leverage the return on equity can be magnified. So, to take care of that particular problem, one can as well go for a moderate level of debts, but high debt equity ratio is not advisable for any company. So, if you look at our example, we have got the debt equity ratio of this particular company, the debt to net worth, which was 0.424 in the 2006-7, it has become 0.490 in latest year. The interpretation of this 0.490 figure is that for every 1 rupee of equity of this company, the company has got around 50 paisa or 49 paisa of debt. That means, it total is 1.450 total of debt and equity. This company has got 1 rupee as equity and 49 paisa as debt. Certain bankers will look at the equity level of this particular company before they actually lend. If a banker has a policy that it can give a loan to the extent of 2:1 debt equity ratio, and if the company has got 100 rupees as 100 crore rupees as equity, obviously this company should be having rupees 200 crore as debt. That is the limit the bank can tolerate. If another company has got 100 same rupees 100 crore as equity and it has got, let us say, 60 crore as debt, in that case 6:10, 60 to 100 or 6:10 or 0.6:1 is the debt equity ratio. In this case, looking at this particular value, if the banker can feel happy to the extent of giving 2:1 to the debt to the extent of maintaining debt equity 2:1, that means, if you assume 2:1, 1.4:1 debt equity ratio can still be taken care with the additional debt. So, 1.4:1 this is becomes 2:1, that means, the company can go to the extent of 1.4 times of equity, that is 100, another 140 crore rupees of debt can be taken by this company comfortably, because this banker themselves believe for this company 2:1 debt equity ratio is ideal, and in that case the company can go for another 140 crore rupees of debt. So, lower debt equity ratio gives the provides an ability to the company to go for a higher debt whenever it is actually required. So, in any case, as we have discussed, debt equity ratio should not be very high, it should be moderately there. So, that, and also the companies will like to preserve the borrowing power, so that they will have initially the very low equity ratio, whenever they need money they can go for a higher debt, and then the debt equity ratio actually can go up. Next we have is the total debt to total capital. In this case nothing, it is same thing as debt to equity ratio, but here instead of saying debt to equity, we say debt to total capital. That means, if you look at this particular example where 100 rupees is equity, 200 is debt. So, we say 200 by 100, that is 2:1 is the debt equity ratio, whereas as per debt to total capital is concerned, we say it is 200 debt divided by equity plus debt, that is 100 plus 200, that becomes 200 by 300, and that is nothing but 0.67, that means approximately 67% of total finance of this company is raised through debt. So, this is in as per debt equity ratio is concerned, this ratio can vary from any figure to any figure, from 0 to anything, whereas in this case the figure can vary from 0 to maximum 100%. So, interpretation wise this figure becomes little better than the debt equity ratio, otherwise the implication of both the ratio is one and same. Then the other category of financial ratio that we have, that leverage or long term solvency ratio, you have, instead of taking the debt as total debt, one can talk about something like long term debt to total capital. So, when you say long term debt to total capital, we do not talk about short term debt, only long term debt, because capital is supposed to be long term source of finance. So, total capital is anyway again total debt plus equity, and in that you take only long term debt to total capital. This is another variation of ratio. And next, another important ratio that you have is called the interest coverage ratio. In interest coverage ratio we talk about is what is, we say earnings before interest and tax divided by interest. So, what happens in this case, if earnings before interest and tax of a particular company is rupees 60 crore for one company, for another company, company A is rupees 60 crore, and for company B is rupees, let us say also 60 crore. Both the company has got same earnings before interest and tax, but because of degree of leverage or interest rate, whatever reason, interest amount or the total debt raised, whatever reason for that may be, interest amount for this particular company is, let us say 12, and for this company the interest amount is actually 10 crore. So, rupees 10 crore, rupees 12 crore. So, the interest coverage ratio, which is EBIT by interest, is nothing but 60 by 12, that is 5 times in case of company A and 60 by 10, that is 6 times in case of company B. Now, one can obviously feel here that the company B has earned 6 times of interest as far as EBIT is concerned, or this company has earned 5 times of interest as per the company A is concerned. That means, for every 1 rupee of interest required, 1 rupees as interest, the company has earned rupees 5, and this case the company has earned rupees 6. What happens in this case? After meeting the interest expense of 1 rupee, in this case rupees 4 is left, in this case rupees 5 is left. This rupees 4 or rupees 5, as the case may be, will be now taking care of the tax, and then we find profit after tax, then we find how much dividend is there. So, higher the interest coverage ratio is obviously good for the company. This talks about how well the company can meet the interest obligation of the company. Very low interest coverage ratio is not advisable for any company. In fact, lower interest coverage ratio will lead to no lending by any company for further requirement as such. The lenders obviously lend a lot of importance on this type of company which has got a high interest coverage. So, they will be very much willing to lend to this company. So, a company which is not able to earn enough money to take care of its fixed obligations like the interest, one of the permanent, one of the compulsory obligations, because interest is something which is mandatory, which has to be paid by the company come what may, whether company makes profit or company makes loss, the interest has to be paid. If the company is not able to comfortably pay the interest and not earn that much money to take care of interest, where interest coverage ratio is very low, obviously this company cannot be that much attractive for any other investor. So, equity investors, though they are not bothered with interest as such, they may still look at this ratio, because only if the interest is taken care, any profit left over, that belongs to equity holders. So, high interest cover ratio can also give some sort of comfort level even for the equity levers, besides lenders who will always look for this particular ratio. Then we have the next one is called fixed charges coverage ratio. In this we talk about the earnings before interest and tax plus any other thing which is fixed for the company to be taken care. For instance, the other fixed charges for the company could be all fixed charges, could be one is interest which has to be taken care, then the company has got something like a preference dividend that also has to be paid by this company, then any loan repayment portion that also has to be taken care. So, instead of taking only interest as in the denominator, one can take for the in this we have earnings before interest and tax as the numerator. At the end of the day, the company has to earn as much operating surplus to take care of interest, to take care of tax, and then to take care of preference dividend, also to take care of loan
repayment. Though the loan repayment is not a part of income statement, but still the surplus created by this company should take care of all the obligations of the company towards outsiders, including government because of tax. So, interest, tax, preference dividend who has to preference shareholder who has to which has to pay to the preference shareholders, and any loan repayment that is scheduled for that day has to be taken care. So, what happened in this case, EBIT in the numerator, interest is in the denominator, plus preference dividend and the loan repayment portion whatever is there, that is to be there, but that has to be adjusted for 1 minus tax, because interest something where you have got the tax effect, because you got tax relief because you claim interest, but within 1 minus t is divided, because you do not get anything any tax benefit by claiming preference dividend or by claiming loan repayment. So, to take care of that tax effect, is divide 1 minus t, and at the end of the day the fixed charges coverage ratio should always be as high as possible. That talks about that yes, the company is going to meet the fixed obligations as comfortable as possible. So, all the investors will always like to see that the fixed charge coverage ratio is very high. So, higher the fixed charges coverage ratio, better preferred by investors across the world as such. Then we go to the next category ratio, that is our capital market standing. As we discuss in this ratio, we talk about what are the how this particular market particular company stands in the capital market. The first ratio that we have in this case is the price earnings ratio, where we talk about the market price per share to earnings per share. So, in this case what happens, we find the market price for this particular share, we find from the capital market, and instead of taking market price per share on a particular day, one can take the average market price during a particular period and divide with the earnings per share of the particular company. Then if you look at our example, we have earnings per share of this company as 15.24, and the 30 days average market price prior to March 31st is 89.44. So, the 89.44 divided by 15.24 gives us a price earning multiple of 5.87, and this price earning ratio of this companies was 11.75 2006-7, which has gone down to 9.89, is gone to 5.87. Though the earnings in this is because of two things, one is that earnings per share itself has gone up, second one is that the market price of the share has gone down from 129.45 to 89.44. So, because of decrease in the numerator value and increase in the denominator value, that is earnings per share, this price earning ratio actually has come down. Now, this price earning ratio to mean, if the price earning ratio of this particular company is taken as, let us say, as in this particular case is 5.87 is the price earning ratio of this company in 2008-9. What does it mean? That if this company is going to earn same amount of earnings per share that is earning in 2008-9, it will take 5.87 years for the company to cover all the price in terms of earnings as such. So, in this case, lower the P ratio is always a good sign in a way that the company's shares can be actually bought. So, how to know lower or higher? There will be certain benchmark price earning ratio. Benchmark price ratio can be defined as median P ratio of different companies as such. So, the median P ratio of the particular company, a particular group or particular sector is let us say 10, and if let us say this price earning ratio of this target company is less than 10, in that case obviously it says that we can go for buying this particular company, because that shows this particular company is undervalued compared to the peer group or compared to the market as such. But if the P ratio average or median P ratio of the industry group is 10, whereas the P ratio particular company that we are evaluating is let us say 12, that means 12 is more than 10, that means this company is actually overvalued. So, in that case the that is a sign that company can go, the investor can actually sell the shares because it is overvalued and or not go for any more acquisition this particular share. So, P ratio is a relative valuation measure, where we can say relative to the market or the industry whether this particular share is overvalued or undervalued. Then we go to the next one, that is our next ratio is called the enterprise value to EBITDA. In this case, what you say, instead of taking the value of the only the equity in the numerator, we take the value of the entire company, that we talk about the value, market value of equity as well as market value of debt, divided by earnings before interest, depreciation, tax and amortization. And in that case, what you will say, in this case, this is also popularly known as EBITDA multiple, EBITDA multiple, and this particular thing is taking care of the leverage effect is neutralized. The asset structure is also because the asset structure, instead of fixed asset structure, depreciation is also neutralized. So, this makes a more comparable across the companies in different particular sector. So, the new company or old company, it can be compared with the enterprise value to EBITDA, and again higher or lower it can be compared to the average multiple, and accordingly one can say is overvalued or undervalued. Then we have got next category ratio is dividend yield, and then we have got price to book ratio. So, dividend is nothing but the dividend per share to market price per share. So, if the dividend is 2 rupees, market price is let us say 10 rupees, so 2 by 10 comes to 20% the dividend yield. And then we have got the price to book ratio, where we talk about the book value share is defined as the net worth divided number of shares, the market price per share is 50 and the book value per share is let us say 40. So, price to book value ratio is known as now 50 to 40, that is 1.25. So, again in this can be the benchmark comparable ratio is let us say for the industry is 1.20. If this company is 1.25, obviously this company is more overvalued than the industry, and will, if I have already invested in this company, then we like to sell these shares of the company, or if I have not invested, not like to go for. But if you find a company which has got a P by B ratio is our benchmark, and the average P by E ratio of the industry 1.20. If you come across a company who has a P by B ratio is 1.15, then that case we will always like to go for a buy decision for this particular share. So, these are the different tools of financial statement analysis. This is not an exhaustive list, rather can be n number of ratios that can be found out with the help of information from capital market as well as from the statements published by the company in terms of the balance sheet, income statement all. So, this is the end of the final statement analysis unit. Thank you.